Saturday afternoon, January 18th, 2026. While you were watching football or running errands or scrolling through your phone, the Russian central bank updated a single line in their reserves database. No announcement, no press conference, just a quiet data upload at 4:37 p.m. Moscow time to a government website that 99.9% of investors will never visit. But that one line, that single number, sitting in a spreadsheet that maybe 12 people worldwide actually downloaded and read before Monday morning, that number just shattered the entire foundation of modern monetary policy, $326.5 billion. That's the value of Russia's gold reserves as of January 1st, 2026, up from $195.7 billion exactly 12 months earlier, a $130.8 billion increase in 1 year. The largest single-year appreciation of any sovereign gold holding in recorded history. And here's the part that should make every central banker in Washington and Brussels lose sleep tonight. Russia didn't buy more gold to achieve that. They actually sold gold. They reduced their physical holdings by 6.2 tons. But while they were selling, while Western sanctions were supposed to be crushing their economy, while the G7 was celebrating the freeze of $300 billion in Russian forex reserves, gold did what gold always does when fiat currencies start collapsing. It went from $2,600 per ounce to $4,400, a 1.7 times increase in 12 months. And Russia, sitting on 2,329.63 tons of physical gold, locked in vaults in Moscow where no Western government can freeze it, sanction it, or confiscate it. Just watch their strategic reserves appreciate by $130 billion while doing absolutely nothing. They didn't print money. They didn't issue bonds. They didn't beg the IMF for loans. They just held gold. And gold rewarded them for understanding the oldest rule in monetary history. Real assets beat paper promises every single time. And the Federal Reserve, the European Central Bank, every Western institution that spent the last 20 years pretending gold was a barbarous relic, they're about to learn that lesson the hard way. Because Russia isn't accumulating alone. And that 326 billion number, as large as it is just the opening act. The real story, the one that's about to destroy dollar hegemony forever, is what happens when you add China's 300 billion in gold, India's 115 billion, Saudi Arabia's accumulation, UAE's purchases, Iran's holdings. When you add it all up, when you map out the next 18 months of BRICS gold strategy, you're not looking at 300 billion. You're looking at 1.7 trillion, minimum. And the Fed has zero tools to stop it. Zero leverage, zero counter moves. Because you can't sanction gold. You can't print gold. You can't QE your way out of physics. And that reality, that simple mathematical truth, is about to reset the entire global financial system, whether Jerome Powell admits it or not. Let me walk you through exactly what happened, because the media isn't going to explain this correctly. They're going to report it as Russia's gold reserves increased due to market fluctuations. Routine financial update, nothing to see here. But that narrative misses the entire point, the entire strategy. The 30-year plan that's been executing in plain sight while Western central banks printed themselves into monetary oblivion. 1999, Russia's gold reserves, 384 tons, worth approximately $4 billion at gold prices of $1,100 per ounce back then. The U.S. held 8,133 tons. Germany held 3,400. The West dominated global gold reserves. Russia was a minor player, a former superpower trying to rebuild after Soviet collapse. Their reserves were 97% dollars, euros, yen, only 3% gold. Standard Western portfolio theory. Gold doesn't pay interest. Gold is deadweight. Better to hold treasury bonds, better to hold euro bonds, paper assets that generate yield. That's what every Western educated economist told them. And for a while, Russia followed that advice. But then two events changed everything. First, 2003, the U.S. invades Iraq, Saddam Hussein's regime gets toppled, and one of the first actions the occupying forces take, they seize Iraq's gold. Not a lot of media coverage, not a lot of public discussion, but every central banker on earth takes notes. Gold stored in your own vaults, that's yours. Gold stored in New York or London, gold that's part of the international banking system, that gold vanishes the moment you become an enemy of the West. Lesson learned. Second trigger, 2008 financial crisis. Lehman Brothers collapses. Bear Stearns collapses. The Federal Reserve responds by launching quantitative easing. They print $700 billion, then $1 trillion, then $4 trillion to bail out banks, to buy toxic assets, to prevent systemic collapse. And Russian economists, the ones advising Putin, they watch this happen. They watch the dollar lose value. They watch inflation start creeping higher. They watch the world's reserve currency get debased in real time. And they ask a simple question. If the U.S. can print unlimited dollars whenever they have a crisis, then why would we hold our reserves in dollars? Why would we trust paper promises from a government that creates new money at will? The answer, you wouldn't. Not if you're strategic, not if you think long term. So in 2009, Russia starts buying gold. 40 tons here, 60 tons there. Nothing flashy. Nothing that triggers alarm in Washington. Just consistent, methodical accumulation every single quarter. By 2014, they hold 1,140 tons. Still modest compared to the US, but the pattern is clear. The direction is obvious. Then February 24th, 2022 happens. Russia invades Ukraine. The West responds with the most comprehensive sanctions package in modern history. The US and EU freeze $300 billion of Russian foreign exchange reserves. $300 billion. Money Russia thought was safe. Dollars held in Western banks, bonds held in Western clearing systems, euros parked in European accounts, all of it frozen. Locked. Inaccessible. Overnight, Russia lost access to nearly half their total reserves. But here's what the West couldn't freeze. The gold. The 2,300 tons sitting in Central Bank of Russia vaults in Moscow. That gold was physically in Russia, under Russian control. No Western government could touch it. No sanction could affect it. No freeze order could move it. And that lesson, the proof that paper reserves held in adversary jurisdictions are worthless during conflict. That lesson echoed through every non-Western central bank on the planet. If it happened to Russia, the world's 11th largest economy and a nuclear power, it can happen to anyone. China saw this, India saw this, Saudi Arabia saw this, Brazil saw this. Every country that's ever had tense relations with Washington realized the same truth. Holding reserves in dollars or euros or yen, holding those reserves in Western banks, that's not safety. That's leverage. That's giving your adversary a weapon to use against you the moment geopolitics shift. The response was immediate. Diversify, accumulate gold, store it domestically. And this is where the strategy shifts from defensive to offensive. Because post-Ukraine sanctions, Russia doesn't just maintain their gold position, they systematize it. Between 2022 and 2025, Russia continues producing 340 tons of gold annually. They're the world's third largest gold producer. And in 2022, the government implements a new policy. Domestic gold production must be offered to the central bank first. Private Russian mining companies cannot export without approval, cannot sell to international buyers without permission. The state gets first refusal on all production at market prices, and the central bank pays in rubles. This creates a closed loop. Russian miners dig gold out of Russian ground. Central bank buys it with Russian currency printed by Russian monetary authority. The gold never touches London, never goes through New York clearing, never enters the Western-dominated pricing system. It stays inside Russia, accumulates in vaults, strengthens the monetary base. And here's the brilliant part. While Russia was doing this, while they were converting domestic gold production into reserves, the Western sanctions designed to crush their economy actually helped them, because sanctions pushed Russia to trade more with China, India, Middle East. And those countries, they're also accumulating gold. They're also moving away from dollar dependency. So Russia's gold strategy aligned perfectly with BRICS' de-dollarization strategy. It wasn't just Russia going rogue. It was the beginning of a coordinated, systematic, multi-decade plan to build an alternative monetary system based on commodity money instead of fiat currency. Now let me show you what happened in 2025, because this is where the numbers become undeniable. January 1st, 2025, Russia's gold is valued at $195.7 billion. Physical tonnage, approximately 2,336 tons. Gold price, $2,600 per ounce. By September 2025, Russia's National Wealth Fund is selling gold to cover budget deficits. They sell approximately 64 tons from the Sovereign Wealth Fund. Not from central bank reserves, from the Wealth Fund. Total Russian gold holdings drop by 6.2 tons over the year. That's a decrease. They're net sellers. But here's what happens to the value. Gold price goes from $2,600 to $4,400, a 70% increase in 12 months. By January 1st, 2026, Russia's gold is valued at $326.5 billion. They sold metal. The tonnage went down, but the value went up $130.8 billion. That's a 67% return on an asset they're actively liquidating. Think about that. Russia is selling gold to fund government operations and still making record returns because the appreciation rate exceeds the liquidation rate. That's not investing. That's monetary alchemy. That's holding the one asset that can't be debased while every fiat currency on earth loses purchasing power simultaneously. And Russia isn't alone. China doesn't publicly report gold purchases in real time. The People's Bank of China updates their holdings sporadically. Sometimes months go by with no updates, and suddenly they announce they bought 200 tons. This creates strategic ambiguity. Western analysts can't track accumulation patterns, can't front-run purchases, can't apply market pressure. According to official data, China holds 2,298 tons as of mid-2025, worth approximately $300 billion at current gold prices. But many experts believe the real number is higher, much higher, because China is also the world's largest gold producer at 380 tons annually. And just like Russia, domestic Chinese production goes to state-controlled entities first. It doesn't hit international markets. It doesn't get exported. It gets absorbed into the system, vaulted, held. Some estimates put China's actual gold holdings, when you include sovereign wealth funds and state enterprises, at over 4,000 tons. If that's accurate, if China's real position is 4,000 tons at $4,400 per ounce, you're looking at $560 billion in gold. Not $300 billion. $560 billion. That's bigger than Russia's entire GDP. That's a monetary war chest that can back an alternative reserve currency for decades. India officially holds 880 tons, worth $115 billion at current prices. They've been buying steadily. In 2023, India bought 28 tons. In 2024, 16 tons. 2025, another 24 tons. And they're not slowing down. The Reserve Bank of India explicitly stated that gold accumulation is strategic policy. Not speculation, not trading. Strategic national interest. Because India learned the same lesson Russia learned. When you hold gold, you control your monetary destiny. When you hold dollars, you trust Washington. And Washington's track record on trustworthiness lately is not encouraging. Now add the new BRICS members. Saudi Arabia officially joined BRICS in January 2024. UAE joined. Egypt joined. Ethiopia. Iran. These countries combined hold significant gold reserves. UAE, 74 tons. Saudi Arabia estimates vary, but likely over 350 tons. Iran, officially unknown, but estimated at 250 to 300 tons. When you add original 5 BRICS members plus new entrants, you're looking at approximately 6,000 tons of gold. At $4,400 per ounce, that's $852 billion in current value. But here's why 1.7 trillion is the target number I'm using. Because BRICS has a stated goal. They want to control 65 to 70% of official global gold reserves by 2027. Total central bank gold holdings globally, approximately 36,000 tons. 70% of that is 25,200 tons. BRICS currently holds 6,000 tons. They need 19,200 additional tons to hit target. 19,200 tons at projected gold prices of $6,000 to $7,000 per ounce by 2027. Because the buying pressure alone will drive prices higher, equals approximately $1.7 trillion minimum. That's the strategic objective, and they're on pace to achieve it. Let me show you the mechanism that makes this possible. November 10th, 2025, BRICS officially launched the unit, a digital currency designed for cross-border trade settlement. And the unit isn't like every other digital currency proposal that's been floated over the years. It's not fiat, it's not unbacked, it's not trust-based. The unit is backed by physical gold, 40% gold, 60% basket of BRICS currencies. The initial test transaction included 40 grams of actual gold per unit. The blockchain used is Cardano. The settlement is instant, and the purpose is explicit. Eliminate dollar dependency in BRICS trade. Let me explain what this means in practice. For 70 years, if India wanted to buy oil from Saudi Arabia, the transaction required dollars. India sells goods to Western markets, earns dollars, uses those dollars to buy Saudi oil. Saudi accepts dollars because they can use those dollars to buy goods from the U.S. or invest in U.S. assets. The dollar was the essential middleman, the global reserve currency, the one asset everyone needed. But with the unit, India can pay Saudi Arabia directly in a gold-backed token, no dollar conversion. No Western banking system, no SWIFT network, no Fed visibility. The trade happens peer-to-peer, central bank to central bank, using a gold-backed digital asset that both parties trust because the gold is real, physically allocated, audited, and stored in BRICS member vaults. This is not theoretical. The first commodity trades have already settled using the unit. Oil transactions, agricultural goods, minerals, all bypassing the dollar entirely. And every transaction that happens in unit instead of dollars reduces global dollar demand by that amount, permanently. The Federal Reserve's response? Silence. Because what can they say? What can they do? They can't ban the unit. It's not subject to U.S. jurisdiction. They can't sanction it. The countries using it don't need Western financial system approval. They can't compete with it by offering a gold-backed digital dollar because the U.S. would need gold to back it. And the U.S. only holds 8,133 tons. BRICS is targeting 25,000 tons. The math doesn't work. The Fed is checkmate. And Jerome Powell knows it. Every speech he gives about dollar strength, about the U.S. having deep capital markets, about flight to safety, those are cope. Those are talking points designed to project confidence while the foundation crumbles underneath, because the data tells a different story. In 1999, the dollar represented 71% of global foreign exchange reserves. By 2020, 59%. As of Q2 2025, the dollar's share is 56.3%, lowest in 30 years, and dropping. Where did that lost market share go? Gold. Gold's share of global reserves increased from 6.4% in 2020 to 12.9% in Q3 2025. That's a 102% increase in 5 years. This isn't drift, this is structural reallocation. And it's accelerating. Let me show you the timeline because this is not a 10-year story. This is happening right now. Phase 1 completed. 2020 to 2023, accumulation phase. BRICS members buy gold quietly, build reserves, test infrastructure, establish domestic vaulting. Low profile. Western media ignores it. Phase 2 completed. 2023 to 2025. Coordination phase. BRICS announces expansion. Adds 6 new members. Launches. The unit in pilot. Gold buying accelerates to record levels. Central banks globally purchase over 1,000 tons in 2024 alone. Gold price rises from $1,800 in early 2023 to $4,400 by January 2026. Some analysts notice, but most dismiss it as inflation hedge. Phase 3, current. 2026 to 2027. Implementation phase. The unit goes operational across all BRICS members. Commodity trades settle in gold-backed currency. More countries express interest in joining BRICS. Western sanctions become less effective because dollar dependency decreases. Gold continues rising as BRICS buys remaining tonnage needed to hit 65% target. Western investors finally start realizing what's happening. Late-stage awareness leads to panic buying. Phase 4, projection, 2027 to 2028. Dominance phase. BRICS control 65 to 70% of official gold reserves. The unit becomes widely accepted for commodity trade globally. Oil pricing shifts from dollars to gold-backed unit. Wheat, copper, lithium follow. U.S. Treasury auctions see declining foreign participation. Fed forced to buy treasuries directly through QE. Dollar enters hyperinflation trajectory. Gold breaks 10,000 per ounce, then 15,000. The dollar era ends. The gold era begins. Now let me address what the skeptics are saying, because I know the counter-arguments. First, BRICS economies are unstable. China has real estate crisis. Russia is sanctioned and struggling. India has poverty. Brazil has political chaos. These countries can't build a reserve currency. My response, reserve currency status isn't about economic perfection. It's about trust relative to alternatives. The British pound was reserve currency while Britain was declining. The dollar became reserve when Europe was destroyed. BRICS doesn't need to be perfect. They need to be trusted more than a U.S. government that prints $20 trillion in 15 years, weaponizes currency through sanctions, freezes $300 billion in sovereign reserves, and shows declining fiscal discipline. Second counterargument, gold can't support modern trade volumes. There's not enough gold. The numbers don't work. Response, gold doesn't need to back every transaction. It needs to back reserve holdings and settlement balances, and at the right price, there's plenty of gold. If gold is 10,000 per ounce, central bank reserves double in value without acquiring more metal. Price adjusts to match monetary demand. That's how commodity money works. Third argument, the U.S. will respond. They'll launch their own gold-backed digital currency. They'll compete. Response, with what gold? U.S. holds 8,000 tons. BRICS will have 25,000. China alone might have 4,000 plus. The U.S. is outgunned. Even if they wanted to go back to gold standard, they don't have enough gold relative to money supply. M2 in the U.S. is 21 trillion. 8,000 tons at 6,000 per ounce is 154 billion. That's a 0.7% backing ratio. Worthless. Fourth, the Fed has tools, interest rates, QE. They can defend the dollar. Response, all those tools create more dollars. Raising rates doesn't create gold. QE doesn't create gold. Every traditional monetary policy tool the Fed has makes the fundamental problem worse. Because the problem isn't demand for dollars. The problem is trust in dollars. You can't QE your way to trust. Here's what happens to you personally when this plays out. You're holding dollars, maybe in checking account, maybe in savings, maybe in treasury bonds or corporate bonds or stock market positions, all denominated in dollars. When the unit becomes dominant trade settlement currency, when oil switches from petrodollars to gold-backed BRICS payment, demand for dollars drops. Foreign central banks holding treasuries start selling because they don't need dollar reserves for trade anymore. Treasury auctions see weak demand, yields spike. Fed steps in to buy treasuries with printed money. That's monetizing debt. That's Weimar Republic playbook. Your dollars lose value. rapidly. Every month, groceries cost more. Gas costs more. Rent costs